You ask a very good question. And the only explanation I have is that precious metals went up a lot before. And when the war in Iran broke out, the precious metals had kind of anticipated the war. And then they started to go down. And I have to say, the market action of mining stocks is horrible. It's very bad. The explanation I have is gold became relatively expensive compared to other things. And number two, the reason for gold having gone down is similar. The bitcoins and the cryptocurrencies also went down. Now they're rallying again. Mm-hmm. But we began this interview by you asking me, why is the S&P making a new high? And I said, we have still plenty of liquidity, but in my view, the liquidity has been shrinking, relatively speaking. So not all assets are making new highs. You understand? Now, for one asset to go up, other assets have to go down or stay at the same level. Say you look until 2018, you have stocks going up, you have real estate going up, both commercial and residential. But more recently, everything goes up, stocks go up, and commercial properties, some are down 70%. Some will never be sold, except for the land value. So, in my view, to your question, why is the S&P making new highs? The S&P is making new highs because we are in a speculative environment. And investors, they read Reddit or the Wall Street Journal or whatnot, or watch CNBC, and they get a tip, and then they pile into one sector. But if you look at the whole market and equal weighted stocks, the market isn't doing well. I mean, my portfolios, I can tell you, and I have diversified portfolios, and some your viewers will, of course, say, Mark, it's investing like 100 years ago. That may be true that I'm not, kind of the greatest tech fan, but I have diversified portfolios. But all my portfolios, they peaked out somewhere, I think, around the end of February, end of March, around that time. Mm-hmm. But since then, I'm still up for the year, but not by much. In election years, and, the current year, after May, the stock market doesn't perform well. And in general, stock markets have a spring rally. We had the spring rally up to this date. But usually from the beginning of May onwards, the market is not performing well. And while the public is rushing into stocks without any caution at all, I would remind your viewers that of course you will say, or your viewers will say, Warren Buffett is an old-fashioned guy, he doesn't know. But it's still interesting that Berkshire Hathaway, his investment vehicle, has more cash today than at any time in its history. And I'm not saying that he's right, but I'm saying that I've studied now the technical picture of the market extensively in the last few weeks, and I've written a report about it. The technical picture is bad. It's not good. The geopolitical picture is not good either. The inflation outlook is not favorable either. And therefore, I'm somewhat surprised that people rush into stocks without any fear. I would use the current strength to reduce positions. That's what I would do. Gold and silver, I like gold and silver, and I'm not going to sell my gold and silver, but I don't think it will go up for the next 3 months. Not entirely sure. In the stock market, you're never 100% sure about anything. But I suppose that there is a lot of liquidity in the system. And so people pile into stocks. And in America, because or part of the reason for the strong earnings growth that we have is excessive liquidity. And so that the government essentially creates this liquidity by money printing, and then the money flows into something, and that something are stocks at the present time. And the American media is very good at detailing how American stocks deserve this huge valuation premium. And so we have this new high in the S&P, which I personally, I didn't think it would happen, but it has happened. It hasn't hurt me in the sense that I'm not short the market, whereby I'm thinking that the shorting opportunities is rising soon in semiconductor stocks. I think there's an opportunity there. But basically, the market has gone up. If you look at the breadth of the market, how many stocks are advancing and how many are declining, and especially how many stocks are making new highs. The technical picture is very bad. The market is making new highs, but with fewer and fewer stocks making these highs. Yes, that for sure. But one thing that has also lifted stocks are the energy stocks that obviously benefit from rising oil prices. But my sense is that it would be wrong to conclude that the rising oil prices are good for anything. In principle, they're negative for the economy, and they are negative for corporate profits in general, because it squeezes the costs of businesses. And
go ahead. Go ahead.
I mean, what the rise in oil prices will do, we'll see in 6 months' time when everything flows through. But clearly, in the past, rising oil prices have not been good for financial assets. And my sense is if you look at the bond market, then it's obvious that some damage will occur as bond yields go up. I mean, I follow the TLT ETF. These are long bonds ETFs. And the yields have been going up. In other words, the prices have been going down, as you can see in your chart. And in my view, this combination of rising oil prices, putting pressure on inflation, and increasing the yield on treasuries and other securities that carry a fixed coupon, in my view, this combination will lead to a huge cost for the US government, in the sense that the US government should benefit from declining interest rates, but now they're not benefiting from declining interest rates, but from rising rates, which then increase the budget deficit, the fiscal deficit of the US, and therefore the fiscal deficit could increase meaningfully and make it actually in the long run impossible for it to come down. And so the government would have to print money to finance this increasing deficits and the increase in the interest payments on the government debt. And that then leads to a complete disaster. I have to laugh because you raise a very important question. As you know, the Fed, the central bank of the US, began to cut rates in October 2024, almost 2 years ago now. And normally, the idea is you cut rates, so you produce a bond market rally, bonds go up, and interest rates go down. But this hasn't happened. They cut the Fed fund rate and bonds went down. In other words, interest rates went up, which, in my view, proves the point that there are limits to central banking, that there are limits to the manipulation of a central bank. And I would argue that the central banks have now lost control of interest rates. They're lost. They may regain it at some point, but not now, because the investors don't